think we can call the meeting to order. I think everyone should have an agenda before them. Is there a motion to adopt the agenda?
So moved.
All in favor? Aye. And I think also in your packet online, you saw the minutes from our last meeting, April 27th. And if there is a motion to approve those minutes, that would be great.
I move.
Second, and all in favor? Aye. I think next on our agenda is the chair's report.
Do you want to check if Reynolds is on the?
Oh, I could say Reynolds, you happen to be called in?
Okay.
So, no.
Yeah. Okay. Very good.
So, I'd actually like to begin my report with saying a special, I'd like to recognize the Treasurer Loftus, actually. As you know, this is, as part of the pension reform bill was to make all of the members of the State Fiscal Authority have uniform appointing rights to commission members. So as a result, this is his last day as a sitting member of the commission, and from now on, he will be the guy, he's elevated to the guy who appoints the guy who sits, or girl, who sits in his chair. So I'd really like to express our thanks for your service, and I know, I think Mike had some words that he wanted to say as well, and I don't want to be redundant because he is much more eloquent than I, but I truly appreciate all of your contributions to the commission, and I actually, oddly enough, appreciate most the times you were most vocal about issues facing the commission. It's very easy to sit in silence and agree. It's much harder to do the opposite. And it's really those disagreements that cause an organization to have to take a very deep introspective look at itself and identify what might be the best course of action and to chart that course. And so as I again, thank you for that, because I think now where we're sitting, where the trust fund's sitting, where the state retirees are, the state employees, and this organization, we're in a better place than we have ever been before. And more importantly, we have a very bright future charted for us. So sincere thanks for your service, and your presence will genuinely be missed.
Thank you very much. Madam Chair?
Yes.
I'm going to have to disagree with you. I think you're much more eloquent than I will be, but I'll try to live up to the expectation. So, when I was thinking about this being the treasurer's last meeting, for some reason I thought about, and think about it, he's been serving basically for 6 years now, and I was thinking about, I don't know why, but Senator Kay Patterson's last day in the Senate popped into mind, and Senator Kay Patterson was an eloquent, often funny member of the Senate, but always with the humor came a great deal of candor, and he served very much as the conscience of the Senate on a lot of issues. But what really struck me was, the treasurer's been serving for 6 years, and the Kay Patterson said on his last day, I've been here for 30 years. I'm going home, so people get less time for murder. So Mr. Treasurer, you're getting paroled a little early. So congratulations on that part. But I think we'd be somewhat disingenuous if we didn't recognize that the relationship between the treasurer and the commission hasn't always necessarily been what it should have been. But I would say, and I bring that up to say kind of as a juxtaposition as to where we are today, and to really think about how far that we've come in not just, I think building a good relationship and building a partnership with the treasurer, but also how far, as you've said, Madam Chair, how far we've come as an organization. There's no doubt that the treasurer's has challenged us as an organization, and rightly so. I was thinking about a quote that I heard that an organization that fails to question will find no answers, and I think that the treasurer has pushed us to be better, to be more transparent, to be more thoughtful about the ways that we go about serving our beneficiaries, because at the end of the day, everything that we do is really about them. It's about I was fortunate I got to, and I say this, and I've said this many times, I got to go speak to a group full of principals at the Greenville County School District, and I said, you know, every day we get up and we work on your behalf. I said, but you know, you guys are probably going to be okay, you know, if something happens. But it's the person who's been, you know, who's been the janitor in your school for 30 years, who's put 2 kids through college that we're really concerned about. You know, not to say that we're not concerned about you guys, but we're concerned. You know, that's who we really need to focus on, and I think that's the treasurer has helped us sharpen that focus. And we're appreciative of your service, and I can say that both personally and on behalf of the organization. And we will certainly continue to you know, reach out to you and gather and gain your thoughts on what we're doing and where we're going. But I just wanted to say, as I said, for me personally and on behalf of the organization, thank you so much for everything you've done for our beneficiaries and to help make our organization better.
And so now on to business. So the primary components of the chair's report today are to go through elements that we need to do in terms of changes. I think mostly changes to governance policies in order to align ourselves with the pension reform bill that takes place, that goes into effect on July 1st. So the first item is delegation to the CEO to execute investment contracts. And I think maybe you found most of these things in online on Watchdocs as well. So there is a motion before us. Would you like me to read it and we can second it and then have discussion on it? So the motion is, in accordance with 2017 SC Act 13, Part 3, Section 10, the Commission delegates to the Chief Executive Officer the full authority to act on behalf of the Commission to execute any documents necessary to implement a duly authorized final decision to invest upon documented approval for legal sufficiency by RSIC Legal and upon expiration of the 3-day business day review period as approved by the Commission on May 1st, 2014, or as the review period may be amended or otherwise superseded or rescinded by the Commission. This delegation shall take effect on July 1st, 2017. I think we count Reynolds' motion. Is there a second? Second. Okay. Is there any discussion on this item? Seeing no discussion, shall we take a vote? All in favor? Aye. Okay, I believe the ayes. Okay, one abstention. Or one, was that a no? Okay. All right, the second component was governance policy revisions. And again, online, you should have seen a very full and complete set of governance policies that were gone through and meticulously amended by our legal staff to be in compliance with the pension reform bill. I think I'll probably go ahead and read the motion again, and we'll have we'll see if there's a motion and a second, and we'll have discussion. So this motion, the Commission amends, effective July 1st, 2017, governance policies 1 through 8, as presented and as amended by the proposed revisions dated June 15th, 2017, from the Chair and Vice Chair to bring the governance policies into conformity with 2017 SC Acts 13, and direct staff to make any technical revisions or formatting edits to the governance policies or other RSIC policy documents consistent with the foregoing amendments. Is there a motion? And a second?
So moved.
Okay, and a second.
A
A second. Okay. Any discussion on any of these?
And Madam Chair, you may want to note that there are proposed amendments that are up on the screen that were also posted to, I believe, there's 3 amendments to the packet of policies as well.
Yes. Okay. So yes.
And I believe the motion encompasses those.
It encompasses the amendments. Yes.
Just for clarity's sake.
I know this is exciting stuff, but
Sorry.
no, that's fine. Take your time.
You wanna- Yeah.
So is this online yet?
Yeah.
Right. That's not the full new code though, this is just the changes. The new changes. SE code will probably answer in front of search.
And the code won't be updated on the web yet.
Right,
Yeah.
for these changes.
Correct, yeah, the online won't have those changes in it, yeah. They won't do that until like January.
So just do a search.
It's not in there. Chief Executive Officer's not in the existing code. Mhm.
Thoughts? Yeah, no,
Yeah,
no,
well,
yeah.
are we to discussion on the second?
Yes.
Yeah, so, I mean, this is just where, you know, we do have the ability to delegate authorities. However, one of our expressed duties as the commission is the employment of the CIO under our current statute, right? This, we're delegating it to the CEO, you know, as well as the board chair and vice chair. And I'm just not sure for a decision that's specified in the statute, whether it should be that far delegated.
Can I?
Yeah.
The changes to the statute
Yeah.
specifically provide that I hire the CIO.
Okay.
Yeah.
So that's in the
Yeah,
new
that-
code.
that-
Okay.
that's in the new law.
So this section will be
This will be
changed
changed.
under old
Yes,
code?
yeah.
Correct,
Okay.
yeah. So, but, it
Right.
gives the CEO the authority to hire, basically to employ all of the staff, including the CIO, and specifically requires me to hire the CIO.
Okay, so that, so we
CEO.
don't have
No,
that,
well,
okay.
yeah, so this is,
Perfect.
so that was, and this is actually more of a little bit of with this change to the governance policy, I think it adds a little bit of actual oversight.
Yeah.
So that you can't have a rogue.
I just wanted to make
Yeah.
sure we didn't have a
No,
conflict.
yeah,
Yes.
this is to make it congruent, actually, with the new
Yeah,
law.
the edits
Yeah,
are
all the edits are to
just-
make
Yeah.
it congruent, so,
Okay.
yeah.
Right.
Good deal. All right, I'm ready to vote now.
Okay, well, all right, all in favor? Aye.
Any opposed?
Any opposed? One opposed. Okay, and then the third element to bring us in line with the new pension reform bill is with regards to placement agent policy revisions. And I'll do the same thing. I'll read the motion and someone can move and second and we'll have discussion. The commission adopts effective July 1st, 2017, the proposed revisions to the placement agency policy as presented. Directs staff to incorporate the revised placement agency policy into the Statement of Investment Objectives and Policies, the SIOP. Reaffirms the SIOP as amended and directs staff to make any technical revisions or formatting edits to the placement agent policy and other RSIC policy documents consistent with the action taken by the commission. Is there a motion
I move.
and a second? Second, okay, any?
Can we have some discussion?
And now discussion, yes.
Right, I realize we have to do this as part of the code. I'm just like more on the practical implementation of this, right? Because placement agents typically implies a third party. However, I've seen contracts in the past where something equivalent of a placement agent policy might be paid internally, right? Meaning some of the big private equity shops have internalized those types of payments. And this gets more into a contracting and who, is that something legal has? Will it come through audit? Like, just how do we practically monitor, right, and get the data to ensure that we comply with the policy, right? And maybe we can take that up as a separate issue from
No.
the approval of the policy, but.
Under the law is I think that the law at least attempts to limit it to, if they're an employee, then I think it's okay. It attempts to limit it to basically to outside vendors and contractors. In the way that I would understand it, Betsy, is in whatever placement agent letter as it is amended, will require managers to certify basically that they're in compliance with the law, correct?
Right, I mean,
Yeah.
it's really, the law puts the burden on the placement agent, and our policy requires that the investment staff get these before the commission or anyone else votes on and approves an investment, and then compliance reviews them to make sure that they're in compliance. But we've made it very clear that now that this is a state law, if they have a question as to whether or not how to interpret that, then they need to engage counsel and review that on their own. We can't give them advice on whether or not their structure complies or not. They just have to certify in writing to us that they are complying and that they're not relying on our advice to do so. And then there are provisions in here if we discover after the fact that there was something represented incorrectly, that we have the option to try and get out of the investment management agreement or liquidate in some other way, if that's the right choice for the commission to make.
You end up with these things as a rules-based ethics code, effectively, not a principles-based. And rules-based are always just evaded. I'll vote against it for that reason. I appreciate the effort, but you've got to come up with something better. As the state ethics law is, rules-based, it's technical. You can do something on Thursday, but you can't do it on Thursday afternoon. Silliness, but that's how it's been working for 30 years, and that's what they do. And I don't think this gets us any closer to it.
Madam Chair, I think the spirit of this is obvious. That the goal is to avoid the external third-party marketing, and then avoid the potential where we've seen other states find themselves in very unappealing situations. The spirit of it, I think, is clear, and it's always hard to capture the spirit in a policy. But as long as we all are clear on what this is seeking to do, I think, we can act in the spirit of it as well, where the spirit might encourage us to be even more conservative than the letter of the law. So, I don't know if I'm agreeing or disagreeing, but.
We're on the same page. I appreciate it.
Yeah.
Yeah, I mean, I just think it's something we'll take up at risk and audit, but obviously there are things that flow directly from this one in contracting and other things. We'll have to figure out how to implement.
Right.
Right.
Any other comments or discussion? Are we ready for a vote? All in favor?
Aye.
Any opposed? Okay, I believe that concludes my report. I believe,
agenda would be investment recommendation,
I think,
Madam Chair.
Jeff, would you like to?
Thank you, Madam Chair. So we're going to shift things around a little bit and move to an investment recommendation. And I'd ask you to consider, we are almost 8 years into, or removed from the bottom of the commercial real estate market. And when you find yourself growing late in a cycle, you start to think about how you need to adapt your approach in order to earn attractive returns and mitigate the end of cycle risk. So given where we are today, 8 years into expansion that has been characterized by very strong growth in property values, we need to be looking at strategies that aren't as dependent upon the continued growth in property values. And in this vein today, we're going to be recommending Brookfield Real Estate Finance Fund 5. It's their latest real estate debt fund, and Alexander Campbell he's already here. All right, is going to walk us through the recommendation. Now, I do want to point out that in the interest of time, this is a re-up strategy. We are in the two prior funds, so if it seems familiar to you, that is why. And Alexander, please.
All right.
Take it from
Thank you,
there.
Jeff. Yeah, as Jeff pointed out, we are re-upping into BREF 5. We were in BREF 3 and BREF 4, so I'm going to try to touch on the high points as we move through this. This is a recommendation for a $100 million commitment to BREF 5, which is a $3 billion real estate debt vehicle targeting net returns in the 9 to 10% range. There is a sponsor commitment of $400 million within the fund, and additionally, you can see the commitment amounts that we've had to the prior two funds. There is a 4-year investment period, over 10 years, management fee of 1.4% on invested, 15% carry above a 6% pref. There is a European waterfall, and the clawback is guaranteed by the parent company, Brookfield Asset Management. With this investment, we'll get a seat on the advisory committee, and our own internal ODD has given this fund a pass, and it's also buy rated by Aon Hewitt. So this is our current real estate exposure, and you can see in the upper left-hand corner, I draw your attention to the red piece of the pie here. You can see we have a 10% allocation to debt, and then with this investment, that will increase to 14%. And then down here at the bottom, you can see that we'll still maintain a balanced core to non-core portfolio with slightly more exposure to the core and core plus space. So a little bit about the market opportunity. We felt that given where we are in the current cycle, that it would be prudent to get a little bit more defensive, but we also wanted to be able to pick up some yield. And we believe that investing in mezz loans will help us accomplish that. And so with the regulations that have been imposed on banks post-financial crisis, we feel that it's really opened the door and created an opportunity for debt funds like BREF. And the biggest change is been right here in Basel III, which is an international accord, and it's made it really punitive on banks to lend transitional and development properties. And therefore, they've been focusing more on core stabilized properties and senior loans. Additionally, the Dodd-Frank risk retention is requiring sponsors to retain a slice of the stack. And while pre-crisis, CMBS was a big capital markets participant for commercial real estate, that has essentially been cut in half. Finally, I would say that the increasing transaction volumes in real estate bodes well for a fund like BREF, which finances acquisitions. Now, these are the players in the commercial real estate lending space. Again, I would draw your attention here to the red piece of the pie. The non-regulated lenders, this includes non-bank debt funds like BREF. You can see in 2011, they were just 9%. By 2016, they had grown to 11%, and they've experienced the biggest growth of all the players. But you can see there's still relatively a small piece of the pie, so they got plenty of room to continue growing market share. And then finally, I would point out in the bottom graphic, again, CMBS has really fallen off. The biggest takeaway I would point out from this slide is that transaction volumes have steadily increased since 2009 and are forecast to remain strong, which again bodes well for BREF. A little bit of background on Brookfield. They manage $225 billion in assets globally. They're the second largest property manager in the world with over $140 billion in assets. And again, we do invest in the prior two BREF funds, and we're also investors in their two equity funds, BSREP 1 and BSREP 2. And then I would also point out right here in private equity, we're an investor in Brookfield Capital Partners 4 as well. What about the real estate? You can see here, across here, the number of properties and AUM that they manage. And it's this breadth of platform that's really going to help them in sourcing loans. It's also going to provide them data and analytics to help them underwrite the loans. And in a downside scenario, it's this that's going to help them to foreclose on an asset and manage it and protect fund capital. As for their investment strategy, the strategy is going to be to originate whole loans, and then they're going to syndicate the senior piece of the loan, the 0 to 50% tranche of the loan, to a third party, which is typically going to be a bank or an insurance company. And then they're going to retain for the fund the 50 to 70, 60 to 80% mezz loan. The focus is on U.S. properties in primary markets. However, they do retain the right to invest up to 20% of fund assets in select markets outside of the U.S. The emphasis will be on office, and it will be mostly transitional properties that they're going to be financing as well, too. And to give you an idea of the type of properties that they've been lending to in the prior 2 funds, the average gross asset value of each property is somewhere in the neighborhood of almost $330 million. So these are sizable assets that they're lending to. And also, while they do have the right to go up into the 80% loan to value range, the weighted average loan to value for the prior 2 funds has just been 67%. So this is an example of just an average building or capital structure. At the top, you have your equity commitment or equity from the borrower. And then below that, you have your mezz loan. And then below that, the senior loan occupying roughly the 0 to 50% tranche. And then over here, these are the type of returns you can expect to get from investing in the different parts of the capital structure. And one of the things we like about mezz loans is the equity cushion that's provided. So you can see up here again, you have your $25 million equity from the borrower or the sponsor. And in a 10% downside scenario, that is going to be absorbed, the loss is going to be absorbed by the equity, whereas your mezz loan is going to remain intact and unimpaired down here. And to give you an idea of how the lending environment has changed since 2008, this is kind of what you would expect to have seen pre-2008. Leverage up into the 90% loan to value with very little equity required from a borrower. So in your 10% loss scenario, the equity would have been wiped out and part of your mezz loan would have begun to become impaired. Whereas today, now you're seeing equity cushions of 20 to 25%. And a little bit about Brookfield's strategy. So say you have a $100 million building right here. $25 million from your borrower is going to be going into that building. Brookfield's going to originate this entire first mortgage, the entire $75 million piece. And then they're going to sell or syndicate the senior piece, the senior mortgage to that third party. And then for the fund, they're going to retain the mezz loan right here. And to give you an idea of the type of pricing you can expect to see, if you're the borrower, you're going to come to Brookfield as your one-stop shop. They're going to be the one lender you're going to deal with. You don't want to have to deal with multiple lenders. And they're going to lend you the entire $75 million, and you're going to get somewhere a coupon, a floating rate coupon in the neighborhood of, say, LIBOR plus 450. So if you're the borrower, that's all you care about. This is all you're going to pay. Well, Brookfield's then going to take that, syndicate the senior over here, and the senior is going to get on their $50 million senior mortgage, they're going to get a return somewhere in the neighborhood of LIBOR plus 250, which leaves a return for the mezz loan in the range of LIBOR plus 850. And in addition to this coupon, they're going to also get origination fees and extension fees, all of which will accrue to the benefit of the fund, and that's what's going to get them into the 12 to 13% gross return range. As far as their prior performance, the BREF series dates back to 2004. They've done a total of 84 loans at just over $3.6 billion in equity capital with an aggregate gross multiple return of 1.35 times. I would also point out they did do 41 loans in BREF 4, and that's because they recycle capital. And while they do retain the right to recycle capital in Fund 5, as they have in all of the previous funds, they have no intention to do it in BREF 5, and they have not done it since Fund 1. And as I mentioned earlier, yes, sir.
Significant drop in return. Was that a result of the financial crisis?
Yes, sir. This was invested leading into the financial crisis in 2007. So they did run into some trouble on a couple of them, but they were able to manage and turn out, I would think, pretty well for a 2007 vintage debt fund. I think they were able to manage through it pretty well. And so, as I mentioned earlier, one of the things we do like about Brookfield is their ability in a downside scenario to protect fund capital and foreclose on an asset, which they've done 6 times out of the total of 84 loans. And across these first 5 loans, they've got a gross return of 1.7 times, which, as you may recall, is actually higher than what they got on the performing loans in the 1.35 range. The other thing I would point out, why I say the first 5, because they just recently foreclosed on loan 6. The other thing I would point out here is loan 3. That was one of the ones done in 2007, and that is the only loan out of all 84 loans in which they've lost capital on the deal. So I would say, in whole, they've done very well when they need to take over and foreclose on an asset, which is something we really like about their capabilities. The property strategies that they'll be lending to, BREF 3 was able to do more in the stabilized space because that was in the 2011-2012 timeframe when there was really a lack of liquidity in the commercial real estate market. So they were able to pick up targeted returns by lending to increasingly more stabilized properties, whereas BREF 4 has shifted back to doing more transitional properties, which again will be the emphasis in BREF 5. Yeah, so transitional property is going to be kind of your typical value-add property. It's going to be a property that maybe is 70% occupied, that needs capital for leasing up, needs capital for capital expenditures like maybe a new elevator or something, or it's going to need money for tenant improvements, something of that nature. So the type of properties they're going to be lending to, the emphasis in BREF 3 was office. It was also an emphasis in BREF 4. It's a little bit underrepresented here because this mixed bucket is a combination of office and retail. But again, it will be the emphasis in BREF 5, and they expect to do somewhere in the range of 30 to 40% of office. And then finally, some of the considerations that we have about the funds. BREF 4 was a $1.5 billion fund. BREF 5 is a $3 billion fund, so they've doubled the fund size. But they've also doubled the size of the staff. And additionally, they've given themselves an extra year to invest the capital. So there's a 4-year investment period in BREF 5, whereas BREF 3 was a 3-year investment period. They're going to continue to target the same loan sizes and the same type of assets. They're just going to do more of the loans. Increased competition from debt funds. You may have read about more people raising capital for debt funds. They're not going to be the size or scope typically of BREF, so they're not going to be out there competing with BREF. They aren't going to have the ability to originate that $100 million plus whole loan. So they're going to be focusing a little bit more on smaller assets, maybe more secondary market assets, or different parts of the capital structure. And then finally, potential for bank deregulation. Anything that's going to occur is very likely to take several years to happen. And additionally, as I mentioned, Basel III is an international accord, so it remains to be seen if we would unilaterally withdraw from that. And finally, just close it and open up the floor to any questions.
I wanted to ask about the hurdle rate, the 6% hurdle rate. Does that suggest that this type of investment is more risky than some of our other debt categories?
I would say not more risky, no, sir. I think most of our other debt categories that we're in, particularly in the real estate and the private markets, come with a hurdle rate like that. You're talking about the preferred return, the 6% pref?
Yes. If we expect 12 to 13%, why do we have a hurdle rate of 6%?
Yeah, and that's a good question. Returns have come in, some from the prior funds. They're expecting to get a little bit less. That is not atypical from what you're going to find in any fund. that may be expecting 20% returns, and they're going to have a preferred return in the range of 7 to 8% along those lines too. So
You don't think that's out of step with other funds making investments like this
no, sir.
in terms of what the hurdle rate is?
I do think it's important can you talk about the evolution of the carry level and the preferred return from
Yeah,
prior
so
funds?
Bref 4 and the prior series, they were expecting somewhere in the range of gross returns of maybe 13 to 14%. Now they're looking at more 12 to 13%. So returns are coming in a little bit. The preferred return in the prior fund was, I believe, 7%. So it has come in a little bit as well too. Was it 8?
Yeah,
Okay.
it was 8 and a 20% carried interest. So this is evolving. Scott's telling me I'm right. So going from an 8% with a 20% carried interest above that to a 6 with a 15, I think is actually a symptom of the environment. So I don't think there's been a change in risk level per se. But there's at the risk of stating the obvious, I think there's more risk in nearly everything today than there was when the values for all risky assets were substantially lower. So I don't want to be the master of the obvious, though. Any questions for Alexander?
How much in total? I mean, we have how many investments with Brookfield? So, like, how big's the total
The
relationship?
total, oh boy.
We got the 75 and the 50 here. A lot of that has actually already come in, been invested, and come back. So I think total exposure
You
to
mean just in
Bref-
terms of measured by
Yeah.
aggregate committed
Yeah,
capital?
like across all products
Yeah.
from that.
So, you have
Private equity is
four
about-
others, is that right? 4 other,
Well, we have the 4 other, the 2 other debt funds, the 2 equity funds, and then the private equity vehicle.
fund. So I don't have the exact number, but I would think of that as being 300 to 400 prior to this. Again, as Alexander said, a lot of that is late and already come back to us. But were you thinking about that in terms of aggregate exposure to the firm or some other aspect? Okay. There are no other questions?
We do have a motion on this investment, which I will read, and we can move in second and see if we have any further discussion. So for Brookfield Real Estate Finance Fund 5, the motion is A, adopt the recommendation of the CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated May 25th, 2017. B, authorize an investment of $100 million into Brookfield Real Estate Finance Fund 5. C, authorize the chair or her designee to negotiate and execute any necessary documents to implement the investment as approved by the Commission. 1, upon documented approval for legal sufficiency by RSIC Legal, and 2, upon expiration of the 3-day business review period as approved by the Commission on May 1st, 2014. And D, authorize the chair and or the CIO or their designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the retirement system's trust funds obligation with respect to the investment. Would anyone care to make that motion?
I move.
Okay, and we have a second. All right. All right. Is there any other discussion on this investment? If not, all in favor?
Aye.
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 Any opposed? Okay, thank you very much, Alexander. I think next on our agenda is the Audit and Enterprise Risk Management Committee reports. Alan?
Yeah, it's pretty brief. We met, we continue to search for the ERM director. Obviously, we don't have anything successful to report as of yet, and we have not otherwise met since that last round of interviews?
And Madam Chair, just to,
Please, yeah.
just to build on that a little bit, we are still actively engaged in a search. We're doing a little bit more of a targeted selection for the ERM director, but Andrew's continued to handle the compliance function for us and is doing a good job with that. We also, hopefully we can have somebody in place, but if we can't, we're going to go ahead and sort of start developing the audit plan for Andrew, and I believe we used Travis from John Page. Sorry, yes, thank you, John Page from PIBA last year to help develop the audit plan. So, and that was going to be outsourced anyway. So we'll be developing the audit plan to present to the audit committee. I think we're probably going to meet. You're going to meet again in the beginning of August. I would think late July, beginning of.
July, but I'm on vacation.
Yeah, so I think it's probably like beginning of August. So there won't be, as far as the audit plan goes, there won't be any gaps in coverage, but we continue to try to find someone who can meet what we're looking for. So.
Okay, thank you. The Human Resources Committee report. Ron.
Thank you. A brief report. The committee met in May, and at that meeting, we were briefed on the Performance Pro software, which has been obtained to assist performance measurement for the staff. A part of that is more frequent performance conversations, at least quarterly, to take place between supervisors and employees. The other discussion item at the committee meeting was the evaluation of the CEO and the CIO. And of course, the big change is that the commission is no longer directly involved in the evaluation of the CIO, although we do have oversight of that, especially with the chair. The other change that's taken place is that these evaluations will be done on a fiscal year basis rather than a calendar year basis in the future. And of course, the big one for us now will be the CEO evaluation, which will come to us to use as part of our own evaluation of the CEO. So those were the main discussions at the meeting. Any questions?
Okay, well, thank you very much. And I think next is the CEO's report. Mr. Hitchcock.
Thank you, Madam Chair. And it's my pleasure to get to introduce some new faces. I believe that they're all in here. The first person that I would like to introduce is LaJoya Broughton. I think many of you have already met her. LaJoya, if you'll stand. LaJoya is taking on a new position for us. She's our new Director of External Communications. She started about, you've been here for a month? A month already. So thankfully she's lasted a month and hasn't decided to run for the hills. So previously she was the Executive Director of the Legislative Black Caucus. She has a ton of experience in marketing, has fantastic relationships, has both an undergrad degree and a master's degree in mass communications. So we are very fortunate to have LaJoya join our staff. From undergrad from Furman and the master's from Carolina. So, so they, and just a very well thought of in the community. And as I told her, I think we won by getting her. So, so please welcome LaJoya. We also have Jonathan Grab. Jonathan joins us. He has a considerable experience as a data scientist. And he's been a programmer both in the military and a civilian capacity. He was a former naval intelligence officer, which being a Army person, I told him is much less of an oxymoron than Army intelligence. He is finishing, he just recently completed his master's degree in financial economics from the Moore School of Business, and he'll primarily be working with James Wingo, doing our quantitative analysis process that we've implemented. And as I think one of his first comments to me is, you guys have a lot of data. So, and now Jonathan gets to tackle all that. So welcome, Jonathan. We also have Alan Brevard, who I think you've probably seen around potentially. Alan will be joining our analyst trainee program. He graduated from USC in May with a bachelor's degree in finance and economics. He's been an intern with us since June of 2016, and he started full-time as a junior analyst this month. He's from Maryland, and we also have Colin Bernier. Colin, did I say that right?
Yeah.
Sweet. I'm glad. Because I was really concerned that I wasn't going to say that right. He's from East Greenwich, Rhode Island. He also graduated from USC in May with a bachelor's degree in international business and finance. He started as an intern for us back in October of 2016, and he's also joining our analyst trainee program. And finally, we have Raven Woods from Blackville, South Carolina. And she graduated from Claflin University in May. She has a bachelor's degree in business administration with a concentration in accounting. She is also joining our junior analyst program. So we're very fortunate to have Raven as well. So thank you. So just like to welcome all of our new faces. Okay. And Madam Chair, really the only other part that I would have in regards to my report is we are, I believe we're right where we need to be, and as far as taking over the responsibilities and the transition under the provisions of the pension reform bill. All of those things are progressing along smoothly. Again, appreciate the cooperation of the Treasurer's Office in helping us get to where we need to be on that. Otherwise, and all of those changes take effect July 1st, and we believe that we'll be in a good position to go live on July 1st when those changes take effect. The General Assembly has completed its work. Our budget came out the way that we expected, so we have no pending issues there. Thankfully, we weren't part of the 40 or so vetoes that are currently pending and evidently going to be pending until January. So so that's completed, and we just look forward to the taking over the responsibilities that we need to take over, and hopefully we'll continue to do the same good job that's been done for those responsibilities up to this point. Certainly answer any questions, Jeff.
If no questions, on to the CIO's report. Mr. Berg.
Thank you, Madam Chair. Before David King comes up to talk performance with us, I want to revisit a topic that I communicated with each of you about on May 10th. At that time, I alerted to you what it was a potential compliance violation, and I need to now confirm that we did, in fact, have a compliance issue relating to the transition of our hedge fund exposure, and I want to explain this as simply as I can. As we've been redeeming from our hedge fund portfolio, we have been replacing that exposure with GAA exposure, and this has taken the form of low-cost passive equity and fixed income exposure. And because we've been redeeming from our hedge funds at a faster pace than we'd originally expected, we've inadvertently exceeded the upper end of the range for GAA exposure. We don't have more equity and fixed income exposure in the plan than we are allowed to have, and I want to be clear about that. It's that we traded these exposures as a package, which means that we classified them as GAA exposure and not, as we should have, with the benefit of hindsight, done as individual exposures to equity and fixed income. If we had done so, there would be no issue. But unfortunately, we made the mistake internally here of doing this as a package deal and called it GAA exposure, thus creating the violation. So I want to report that we have fixed this issue simply by breaking the exposure into the constituent parts and reclassifying as equity and core fixed income. This was done, keen to point out, without any trading or cost, simply by making an accounting adjustment. Let me pause here to see if there are any questions about this issue.
Have they been coming down in the index funds or with one of our GAA managers?
I'm sorry.
The money, as you were bringing it down, was it going into our GAA managers or into?
We just
the
added
other
overlay
business?
exposure.
So it was
Just
purely
MSCI
accounting.
World Futures basket
Yeah.
and Treasury futures. It was, yeah, we wanted it to be very liquid because we know at the end of the year, this is exposure that's going to change as our aggregate GAA exposure comes down. So anyway, if there are other questions, I'll take them now. I just want to make sure that we're handling this in the most forthright manner that we can. So I don't have much to say about the performance of the plan. This is really a continuing story from what we've talked about before. But let me give you, David's going to get into some detail there, but let me give you a very current perspective. We feel right now, based on our best estimates, that we are up for the fiscal year somewhere in the neighborhood of 12.5%. We are keen to not count our chickens before they hatch for this fiscal year because I'll remind everyone that tomorrow is the 1-year anniversary of the Brexit vote. So anything can and often does happen. So with that, I'll step aside and let David walk you through the performance as of April, correct?
Yes. Good morning, everybody. Good morning. We'll be going through our fiscal year-to-date performance through April. As Jeff mentioned, he already addressed the compliance issue, but every other asset class is within our ranges. And so I'm going to go ahead and move on to our actual performance. Fiscal year-to-date, the plan has returned 10.47% return versus a policy benchmark of 9.66, giving us 81 basis points of excess return. Looking at that same performance expressed in dollars, you can see that we have paid out $940 million in net benefit payments, giving us a $2.8 billion of investment gains, and that comes out to about $1.9 billion of asset growth in the plan. Moving on to our actual asset class performance, this is a very similar story as the last update we gave you. You can see public equity leading the pack at just under 16% return, followed closely by private equity at 14.2% return, and then private debt in the double digits at 10.67% return. Lagging in the portfolio are our other opportunistic implementation, which is our commodities exposure, core fixed income, and public real estate. And you can see since the last time our infrastructure exposure has gone back into the positive territory. Looking at relative return, you can see our portable alpha hedge funds are just under 7.5% excess return to their benchmark, followed by our non-portable alpha hedge funds and our emerging markets debt implementations. On the other end of the spectrum, our commodities, infrastructure, and public real estate exposures are struggling relative to their benchmarks.
Just a question on the commodities.
Sure.
What's the makeup of the commodities? Is it largely oil, or is it varied commitments?
It's a diversified exposure.
Yep.
It's if you think about the Bloomberg Commodity Index, it is about I want to say 35 to 40% energy. And I'm not able to give you a precise level of oil, but if you think the old index that we all grew up with was the Goldman Sachs Commodity Index, that had a much higher level of energy in it, and the reason for building any exposure off of the Bloomberg Commodity Index was to mitigate the single exposure taking the predominance of the risk weight. So I hope that's helpful.
So looking at our absolute return on the x-axis and our excess return on the y-axis, you can see most of our asset classes are hugging their benchmark pretty well, with the exception of hedge funds, which have a significant excess return. And on the other end of the spectrum, you can see commodities down towards the bottom, underperforming their bond and equity benchmark, and then core fixed income and real estate in the negative territory as well. Taking our 81 basis points of plan excess return and disaggregating it by asset class, you can see 15 basis points is allocation effect, and then the majority is coming from selection. Our overlay collateral, which is our portable alpha hedge funds, short duration and cash, has returned 3.77%, which has added about 73 basis points of plan excess return. So that program's been very successful. And then looking at the asset classes, emerging market set and non-portable alpha hedge funds have added about 22 basis points of excess return. On the other end of the spectrum, that commodities implementation has detracted about 32 basis points, and GTAA has detracted about 8 basis points. And you can see this same information just in a visual form over here. And at this point, I'll pause for any questions.
It always bothers me when we see the overlay doing so well. I think back to 2008 when the overlay lost, what, $1 billion in 5 months or whatever it was. I mean, it's great while it roars, but when it doesn't, it's a great cause for concern. I'm sure y'all are watching it carefully.
What's in that other opportunistic bucket?
So that's the bucket. We used to have a target allocation to commodities. That's still commodities.
Okay.
This is what we talked about maybe a year ago, or I guess it was inside of that. Thinking about other types of strategies that can be very diversifying, tips, insurance-linked strategies. We just haven't gotten to the point where we're ready to bring those into the portfolio. We're bringing them here, frankly, for consideration, and then
So it's
potential.
still the commodity.
It's still the commodity exposure, and it is exceedingly painful. So
It has been-
I'm going to come to that in a few minutes.
It's been the perfect hedge because no matter what the day, no matter what the month,
It's down?
it is down against whatever we make.
Yeah. So that's going to come up again in a few minutes.
Thank you, everybody.
Further questions? Suzanne, you have
Yeah,
anything you'd like to point out? and
yeah, we have a
discuss?
couple of pages that we'd like to look at real quick. And I'll actually, I can do this one here, if that's okay. And then I'll have Tim talk about a few additional comments. Really just talk about the markets. Here we've got this through 331. And I just think, let's all step back for a second here and look at that top kind of set of white numbers here. So these are the various equity benchmarks worldwide. And again, this is through March. But just some staggering numbers up there. So looking at the 1 year, the 3 year, even the 5 year for many of these components. So the S&P 500 and the Russell 2000 really stand out obviously over the 5 year period. And if you look below that at the MSCI EFA and the emerging markets for that 5 year period, pretty tepid results. We've seen a real turnaround in the last couple of months on that. I think that's a positive for you. It's been actually something that's been a bit of a headwind because you've had a somewhat higher allocation to non-US than many of your peers, and that's something that hasn't always helped you. In this calendar year so far, we are seeing a lot of strength out of that. The emerging markets were the first to pop back. We're seeing some exceptional returns, obviously, for the first quarter, and we're starting to see the developed European markets kick in as well. A couple other things that pop out on this chart. Commodities we already talked about, so I won't beat up poor commodities, but Curtis, to your point, obviously the 3 and 5 year results there are very dismal, even for this non-oil heavy index that we have here. One thing I did want to point out was the hedge fund index. So we've been looking at 3 and 5 year results that are, again, in the tepid range. This past year, not to draw big trends from 1 year's worth of returns, but we are seeing better results out of the hedge fund world. And obviously selection is essential here. You've had very good selection over the past year as well, as we just saw in the attribution chart, but we are seeing some better results out of that market as a whole. We're in an incredibly low volatility environment right now, which generally is not favorable for hedge funds, but there has been some very interesting world events that hedge fund managers have generally navigated pretty well, and we do believe that this is something that's a very important part of the program going forward. The other area I wanted to point out was real estate. Let's look at the one-year return here, only about 7.5%. That's what we think of as the long-term norm for core, generally low leverage, quality real estate. Contrast that with your 3 and 5 year results in the 12% range. We are seeing dampening now in the real estate market. We've had 2 consecutive quarters of housing starts being down. We do not think that we're going to go over a cliff. There's a nice balance right now on supply and demand where we are not looking at excessive supply in the real estate market. Interest rates are still low, even though they've inched up a bit. Economic numbers are generally positive, but there's a lot of caution flags, and we agree completely with staff's assertion that we're late in the real estate cycle, and it is a good time to be somewhat defensive. So being a little lower in that capital stack, having a bit more on the income side is really going to help protect you against shocks in the real estate market, and you've already positioned yourself well for that. So we think real estate is still something you should be in good times and bad, but lean a bit more toward the defensive side when we're at the tail end of the market like we are right now. The reason I wanted to look at this chart for a second is we do look here at fiscal year-to-date returns for markets through the end of May. So what we just looked at from staff was through the end of April, so just to kind of make sure everyone's on the same page. And some of these trends I talked about. So now we're looking at a year-to-date return from the EFA, or developed non-U.S. markets. It's actually in excess of the U.S. stock market, which we haven't seen in some time. And emerging markets have done exceptionally well. Interestingly, consumer confidence is at a 10-year high in Europe right now. And that might be surprising when you think of all the extraneous, exogenous kind of events that have happened, and changes in elections, well, not changes in leadership, obviously Brexit, obviously a great deal of terrorist activity in some of the countries. And we're still seeing consumer confidence at a high, which is fascinating. And as a firm, we actually see non-U.S. developed markets as one of the more interesting places out there right now. They're still at a relatively high valuation, but nowhere near as high as the U.S. stock market. If you look at valuations in the U.S. stock market right now, we're getting really close to being at an outlier event right now in terms of valuations. Doesn't mean you should take money off the table necessarily there, but it is something to be, it's very prone to shocks right now at the valuations we're at. This is some of the economic highlights here, and just the GDP growth numbers have been coming in pretty positive, actually more positive than most people had forecasted. So we're seeing some strengthening in economic growth over the past year, but there's some recent signals that are a little bit disconcerting. We all have talked about the dollar. That's not surprising that after this huge trend upwards, we've had some dampening of the dollar against major currencies. And then oil prices, kind of interestingly, OPEC, of course, has cut production, but other countries have kind of increased theirs, so we haven't seen that uptick in oil prices that were anticipated, and thus a lot of the commodities indices are still pretty weak. What is a little nerve-wracking, though, is that we have a great deal of potential for change in the world right now, and that causes the potential for downside. If you look here, this is something called the surprise index, and we're looking at this by country. So you can see US, Japan, Eurozone, the UK. And if you look at this trend, think of zero as everybody's meeting expectations. So whenever we're looking at economic variables, there's always people prognosticating what's going to happen, and then we see the actual results come in. So the surprise index is an interesting measure of have they been right or have they been wrong? And if they're right, it's always at zero. If they've been wrong, they could surprise on the upside. So it's a positive surprise. Earnings came in better than we thought. Unemployment's lower than we thought. Or it can be on the downside. Unemployment's higher than we thought. Earnings are not coming in. Interestingly, we've seen a tapering off of this surprise index, which is a little disconcerting. And actually, Tim just told me, I hadn't seen the May numbers yet. We're right around this zero range, coming off of some very nice surprises. We're now actually at about -40 on this measure in the U.S. So we are seeing a bit of perhaps too much optimism in the markets, and it's something to be cautious about. As a firm, we always do these 1 to 3 year medium-term views, and you may just say, okay, so what do we do with all this? The short story is there's nothing out there that's really screamingly undervalued, and I'm smiling at Jeff because I'm sure he lives in this world, and there's nothing that has this great buy opportunity written all over it. A lot of our markets are in a very mature state of their cycle. They're fairly valued or on the higher end. So what do we see as interesting? Basically, it boils down to we think it's a good time to be very well diversified across market exposures, that there isn't one asset class that looks like a very appealing place to be. So diversification is the essential first message. We do see alternatives as continuing to be attractive. Private equities toward, there's a lot of money chasing private equity, but good deals can be found there, but selection is essential, and you've been very careful about that. Real estate, defensively positioning yourself makes sense. We see hedge funds as still being attractive, as I talked about earlier, and I actually think with the potential for volatility in the markets can be even more so. So good hedge fund managers out there we believe will be additive. In the stock markets, we see them as more attractive than the bond markets. Not surprisingly, the bond markets are a pretty dismal place to be these days. In the stock markets, we do see non-U.S. as being somewhat more attractive than U.S. and developed being more attractive than emerging markets. So that's our overall kind of view on what we think is going to happen over the next 1 to 3 years. And with that, I'm going to pass it over to Tim to just make a couple of comments about performance, and then we'll tie things up.
Sounds good. So this page summarizes the next couple slides, so I'm just going to go ahead and move through it pretty quickly. There was one portfolio manager, I guess one team change with one of your managers, and that was with Times Square. They parted ways with one of their senior analysts that worked on within the energy sector, and the coverage was absorbed by other team members. This firm historically hasn't had a lot of turnover, not too concerning from our standpoint. We understand the reason for the change, so we maintained our buy rating. As Jeff had mentioned, aside from the GAA component, which had to do with a lot of the transition activities that are occurring at present, everything else was in compliance at quarter end. And as we show here, this is just the change in market value during the first quarter. So at the end of the first quarter, you were pretty close to $30 billion, $29.7 billion. That change had to do with, or that almost $1 billion in change from at the beginning of the quarter or at year end was a $976 million change, investment earnings of about $1.2 billion, and then net withdrawals of about $236 million. So this slide here captures performance at the end of the first quarter, and what you see here is on an absolute basis, particularly over the shorter term period, so anywhere out to maybe the 1 year period, really strong absolute results. Reminding you that, first of all, these are all net of fees. But maybe more interesting or maybe even better is relative to your policy index. Over each of the time periods shown here, you can see relative outperformance over the 1, 3, 5, and 10-year period. Not shown on this page, but if we were to look at ranks, the ranks have continued to improve over the last several years. Over the 1 year period, you're in the top third, so ranking 31 relative to your policy index of about 54. So really strong results, particularly over the most recent few years here. This slide, we break down the overall portfolio into the 5 different buckets that are the large buckets within the asset allocation here. If you look at the left side of the graph here, you can see that the traditional, largely the public markets, but private equities also within equity there, has performed well. So if you actually looked at the individual managers within the equity portfolio, you can see that at least over this most recent quarter, there was really only one manager that underperformed. However, they produced a strong absolute result, over 5%. Within the non-core, or within the core fixed income rather, all of your managers either matched or outperformed the index over the period. And then you can see, if you look at the all the way right side of the page, the one area that maybe didn't do as so well would be opportunistic, and a lot of that has to do with the commodity exposure, as Jeff noted. So the Barclays Index, or the Bloomberg Commodities Index has about 30% in energy, as we talked about. If you took energy out of the index returned 2.8% positive, With energy, it was down about 2.3%. So you can see that was a big driver of performance over the most recent quarter. And that's all I had. The only other comment I would mention is obviously staff showed you a report with a lot of these results through April. There was a lot more green on their report, so even more improved results during the month of April for all of your managers across the portfolio. I think that's all I had.
Before we move on, if I could just take a minute. This is our last meeting with you all, and I just want to take a minute to thank you. It's been quite a ride over the last 5 years. I've enjoyed it, though, and I think you all should be tremendously proud of what you've accomplished over the last 5 years, which is really the only window I've had into your world. We've worked with a very talented staff, very dedicated and passionate commissioners. Not everyone's always agreed, but I think we've come out in a very positive place. And I was just kind of reflecting on what we've done together to kind of improve this plan to meet the needs of your beneficiaries, which is at the end of the day what we're here for, is to make sure that these assets are well managed and there for the people that you're serving. I think over this time we've improved governance. You effectively work together quite a bit better. The staff and the commissioners have very clear roles that I think everyone is very comfortable with. Cost has gone down materially. You've removed a lot of higher cost programs in the plan that maybe weren't earning their keep. You've negotiated aggressively with managers to get better fees. You've eliminated a lot of deadwood in the program. There were managers that maybe hadn't been earning their keep. They were doing fine, but continue to set the bar higher and higher to just continually look for ways to improve that. And you've had very positive measures to control for risk and to take advantage of opportunities that have been put in place. So I'm very proud of all the work we've done together. I hope we've contributed positively to it. And of course, we wish you nothing but the best. But I just want to take a minute to do that before we moved on in the agenda. Thank you.
Thank you very much.
Sam. Yeah. And I must say, it is hard to believe that our 5-year partnership has been 5 years. On behalf of the commission, I would really like to extend our thanks to you and to Tim and to all of your colleagues for your continued guidance and support and help over those 5 years. Aon Hewitt has brought this tremendous breadth and depth of market research and analysis that have supported our mission. And I really appreciate, most of all, your candor and your willingness to share your views with us in many of the difficult issues that we have faced over these 5 years. So we wish you the best. Thank you very much.
And I would like to add to that, from the front row seat that I have, I can attest to everyone about the professionalism of Suzanne and Tim, and deeper, Phil Kavarkis, the whole team, and that's really important. Especially, I wound up in the seat somewhat unexpectedly. And they were there to meet me with a steady hand and to be the support provide the support to me that I needed to help me grow into the role. So I have a personal appreciation for Suzanne and Tim and the way that they've helped me. And I think it is always important to remember that we have not always been the easiest client. And during those times, Suzanne was sort of an emissary of sorts. Trying to help, the staff especially understand the concerns, in a clear, concise way, so that we could be thoughtful about how to address them. So, through a challenging 5-year period, I can't imagine we would have been better off with anyone. So, thank you. Madam Chair, I'd like to move on to talk about some projects that we've been working on and will continue to work on. And the reason I'd like to do this periodically is to let the commission know what we're working on, because it often will it will move into a stage where we then move to take action and bring recommendations to the commission. So I want to give you an update on a couple of fronts here. At the last meeting, I believe I mentioned that we'd identified some additional challenging beliefs topics, and I won't go create the full backstory there. But we started with a really interesting one that I'd like to share with the commission. So, and this is admittedly going to be fairly nerdy in nature, so I apologize. I started asking questions about our use of equity options. I like the strategies and I like what we've done in the portfolio, but I was thinking about how the principal way we continue to look different from the broad universe of pension funds, and there are a lot of really smart people out there who have been doing it a little differently from us. The principal way that we look different from other pension funds remains the amount of equity exposure we have. We've started to add equity exposure, and I don't want to add equity exposure simply because other people are doing it. That's a terrible investment thesis. But we need to understand the way we look different and reflect on that. So thinking about the use of equity options, in our portfolio we have less equity but more credit. And I wanted to hold equity options up against the way we invest in credit and ask ourselves, when you think about at the base understanding, we're talking about two strategies that have finite upside but all downside. So, in terms of risk. So I asked our team to think critically about how we use high yield and credit in our portfolio versus equity options from a portfolio utility perspective. So the output from this project I find to be one of the more interesting projects that we've done, and I'm just going to walk you through kind of step by step how we see this. So our thesis for equity options was and is that you get an equity-like return, but you get it with about 2/3 of the volatility. So when we looked at this and tested just downside scenarios, it looks to us like the downside of equity options is actually very comparable to the downside of credit, non-investment grade credit. But because high yield doesn't return an equity return over time, that right there would lead you would lead a rational person to suggest equity options are a better asset. So I'm going to set that up and set it aside for a second. But curiously, what they found was from those lows in the market, high yield recovers meaningfully more quickly, robustly. So high yield is sort of the first responder on the way back up and moves meaningfully ahead of equity options. So that's a point for credit. But then when we started thinking about what is it going to be like during those periods, those dark periods when all risky assets have been beaten up fairly severely, during those environments, an equity option portfolio is liquid. You can liquidate, and you have what, not to confuse terms, but there's a principle of real options, and you would have a real option to adapt to that changing environment. High yield in that environment, I'll use, this is not all drawdowns, but I'll use the drawdown in the financial crisis. High yield bonds had gone either no bid or with a bid 8 percentage points wide of the ask. And that is not an environment into which you want to have to withdraw, from which you want to have to withdraw your investment. You'd like to be a provider of liquidity and exploit that. So that's another point for equity options. So it's also important for another reason, thinking about the plan liquidity risk. At moments when, like today, everything is liquid because there's just a tremendous appetite for risky assets. But in the environment when there is not an appetite, we fully expect our private asset managers, private equity, private credit, to be seeking to deploy capital into that environment. And we think it makes the most sense to be able to do so from an improved liquidity position. So the two important takeaways from this as we see them are, one, we're getting a better sense of how we might choose to employ both of these assets. And it may mean we come back with a recommendation to reduce the amount of credit in our portfolio and increase the amount of equity options. We're continuing our work. That is not a conclusion for today. But also to manage them in a tactical way, so that we can be constantly looking at relative value. And then, obviously, once we have a recommendation of that nature, we need to contemplate whether that is a strategic or a tactical recommendation. So it's an interesting project, and I want to ask for a moment if there are any questions before I continue. Or comments, frankly.
So we've come a long way since the article about pennies in front of the steamroller.
Oh, that came up this week again. That was, I don't want to say anything disparaging about the institution in which that article was written, but I found that to be disappointing from a journalistic standpoint, to characterize an alternative to full risk, a risk-reducing strategy versus just having naked equity risk. I found that to be a little dispiriting, and it came up when Mike and I were across the street. So those things get picked up, and that was unfortunate, but yes.
So we didn't let bad journalism
Prevent us from doing the right thing.
prevent us from doing
Yes.
the right thing.
Yeah.
Good.
So let me make you aware of a handful of other projects that we're working on. First,
Can I maybe just
please.
challenge as you're looking at
Please.
this question? Because I
Yeah.
think there's a point at which aggregation helps and there's a point at which aggregation hurts, right? And index construction is a very important issue. And I just bring that up because just take Amazon, significant portion of the S&P, very different balance sheet than a typical high yield company, right? So your equity options may, depending on how they're structured, right, be on companies that have different looking balance sheets. If you're writing them on an index versus large subsets of names,
Sure.
right? I mean, there's other implementation choices.
Security level versus aggregated.
Correct.
Yeah.
But even if you took a large number of things, right? So, for example, take the S&P 500. There are close to 200 companies that have no debt on the balance sheet, right? So you got a much different animal if you strip those 200 out versus that 300 and still have a large number of names.
Oh, sure.
So I just say that's going to influence.
Well, those really aren't
right.
probably the high yield issuers, most of them either.
Correct.
Right. So-
Like on average, it's an investment grade index.
Yeah.
Right. So like if you look through, and that was one of the things about the financial crisis, people didn't do the look through, but on average, it's an investment grade index and actually a high investment grade. It's a typical S&P 500 companies in A credit or better. Right. So you want to make sure in doing that work that you look at some of these adjustments, and you might have to pull some subset indexes and things like that to get a true
understand where it's
correct
where the differences are
correct
emanating from.
Yeah.
That's a fair point.
and it challenges. Think maybe there are different implementations that look different, right? I mean, I've seen some interesting stuff on like dividend strips for companies that don't have high levels of debt and things like that, right? I mean, there's other implementations that can be unique and different, and what happens when you aggregate up, a lot of times people wind up taking what I call unintentional exposures, whether it's currency, whether it's a lot of equity risk because they want a dividend, right? Well, there's a cleaner way to play the dividend trade than just plucking it down at historically low yields, right? If that's the effect you're trying to isolate. So I just say challenge the team to.
But I think what you say about equity options, frankly, you could also say on the high yield side too.
Absolutely.
Right. I mean,
Right.
there's tremendous dispersion of qualities and outcomes that all are.
Right, and always look
Have a
at
story.
the time period, right? Because your high yield, right? If average recovery is 57 cents, if I start that study at a point in time when high yield is 93 cents on the dollar, I'm gonna get a different result than if my starting average price is 80 cents on the dollar versus my starting price average price is 60 cents on the dollar. Price matters, right? And a lot of times we'll do a back test or a back study, but the period chosen greatly influences the decisions you're going to make. So make sure you understand the assumptions and the inputs. Right.
Absolutely. Let me highlight a few other. I'm not going to get into everything here, but let me highlight a few other challenging beliefs kind of topics. One, portable alpha. How much risk is too much risk emanating from portable alpha? So, we just added it, but that does not mean it is exempt from its moment under the microscope. We're going to step back and take a look at different ways to think about how to hedge. This is the connectivity to the commodities. Some different ways to hedge a rising inflation environment. You don't want to have all of your assets, gain only from a declining inflation environment. You'd like to have, some portion of your portfolio that is responding favorably in that type of environment. So we're going to look at different ways that we can do that. Understand that to be a challenge to commodities as the incumbent way of thinking about that. And then we're going to look at the case for investing in smaller private equity and private credit managers, small and emerging managers. There's a lot of data that suggests this is a potentially meaningful source of excess return, so we're going to look at it. But if we find that to be the case, we're also going to have to understand how would we invest in this space, because I am not keen to be making a series of $5 and $15 million commitments. So if there is a case to be made there, we need to find the right partner to work with. Aside from that, I want to give you a little bit of an update. I've talked about co-investments a handful of times. We continue to look at the use of co-investments as a means of improving the cost effectiveness of our private portfolio. And just as we are doing with our fund investments, we're employing a very highly quantitative approach to considering this issue. The goal is to answer two elemental questions. One, should we avail ourselves of co-investment opportunities? And two, if so, what's the right business model for us to do so? So we've been exploring that for several months now, but again, we're being very intense and rigorous with our quantitative approach. So we're gonna, but I could see that coming to the commission as a kind of thematic concept, and we want to talk about things. I want to sidebar for just a moment this issue of discretion. When we feel that we're doing something that is not kind of standard fare for what we've done before, that's an obvious moment for us to have a discussion with the commission about an investment. So then thinking about risk for a moment, we talked at great length at the last meeting about the evolving liquidity needs of the plan, and we have a kind of a 7 to 8 month period of time of a substantially elevated liquidity need during the unwind of the Terry program. So we're going to spend some time here contemplating and looking very quantitatively at our liquidity risk. And I think, Alan, you and I talked, you've mentioned in this setting, that's a very corrosive form of risk and can take people dramatically unawares if you're not a student of your own liquidity risk. So we are going to be prioritizing that. It's easy to grow complacent from the environment we're in right now, but that's we're not going to fall victim to that. So we're going to be doing a lot of thinking about our liquidity risk. We're going to be exploring the right ways to quantify and report on it. So we're going to be challenging ourselves to provide a little better kind of perspective for you all on the liquidity risk of the plan. So obviously, we'll be back to share that when we get to a place that we're satisfied with. So happy to take any questions or comments or thoughts.
Thank you very much. Those are exciting projects.
Thank you.
I actually, not any discredit, but when Brian Moore described the equity options versus mixed credit, he really made it seem a lot more exciting.
Well, Brian.
Yeah.
Brian, next time.
You're in.
This is his meeting off this time.
But thank you very much. I think at this point in our meeting, if there's a motion to recede into executive session to discuss investment matters pursuant to SC Codes sections 91680 and 916-320, and discuss personnel matters pursuant to 3470A1 and 3470A2, I would be open to such motion.
I'll make that motion.
And a second. All in favor? Aye. Any reportable action while in executive session? Any action that did occur while in executive session? Well, do I need to read all of this? No action was taken. No action was taken. Thank you. Total inaction. Right. So is there a motion to adjourn?
Yes, ma'am.
And a second?
Second.
All in favor? Aye. Thank you very much.
Thank you.